Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So the time has finally arrived. The all-new Portfolio Survival Calculator, a 95-year historical portfolio stress test, has now been incorporated with and is included with the Financial and Retirement Planning Calculator. And my question to you is, will your portfolio make it? So you're thinking about retirement and you're thinking about the longevity of your portfolio. Now think about this question. What if you had retired right before some of the largest market downturns in modern American history? The early 1970s, Vietnam, Watergate, the markets were down substantially. Black Monday, October the 19th, 1987. What if you had retired right before this day? The inflationary bear market of 2022, just a few years back. Ask yourself and discuss with your better half the next time retirement planning is on the table. If we had retired at one of the worst possible times for the market in modern U.S. history, would our portfolio have survived a 30-year retirement? On a similar note, which 30-year historical window was the most brutal for retirees, and would our current portfolio have made it? Which item matters more to our portfolio's longevity? Is it the sequence of returns in the first 5 retirement years? Or is it the average return over the full 30-year retirement period? What if the market craters in my first 3 years of retirement? Should I reduce spending, and if yes, by how much in order to give my portfolio a fighting chance? How do I maintain my current standard of living and leave something behind for my heirs? How much buffer do I need above my minimum acceptable spending level? And finally, what are the odds, based on real-world historical data, that my current portfolio as of today could last a full 30 years at my current spending level in retirement? The answer to every one of these questions, for your specific facts and circumstances, can now be found using the Portfolio Survival Calculator, which, as I said, is included with the FRPC. And so now let's address the question, so what does the Portfolio Survival Calculator allow you to specifically do? Well, to answer that, let's first go to our 2026 cash flow planning flowchart to understand the basics of the calculator, and then we'll hop directly into the FRPC and test the new calculator out for ourselves. Also, at the end of this video, make sure to test your cash flow planning knowledge with my all-new official Number Crunch Nerds quiz that is called the Drawdown Protocol. You can find a link to take the Drawdown Protocol quiz in the description below this video. And by the way, if you enjoy this video, please like and subscribe, and let me know in the comments what's going on in your personal 2026 financial planning situation. Okay, so here we are in our 2026 cash flow planning flowchart, and we have a lot of material to work through in the FRPC program in 2026. We are building out full financial plans inside the course. If DIY financial planning is what's on your agenda, my 2026 FRPC program is where you want to be. 100% calculation transparency, the lifetime financial planning cycle between the accumulation of net worth through the distribution of net worth in your retirement years. As I said, we have a ton of material to work through in the program this year, but for purposes of this video, we're going to be focused on this section of the flowchart right down here. This is the part of the process where you are figuring out your appropriate distribution rate in retirement, whether that follows the 4% rule or some other approach, in order to maintain your desired standard of living in retirement while simultaneously focusing on the resilience and longevity of your portfolio during that process. Is that I have downloaded the U.S. market historical return data for these 7 asset classes right here the S&P 500, US small caps, 3-month treasuries, the 10-year bond, BAA corporate bonds, real estate, and gold. This historical market information was compiled by the Stern School of Business at NYU, and it contains the annual market return data from 1928 through 2025 for all 7 of these asset classes right here. And so within the portfolio survival calculator, you can allocate your existing portfolio or whatever you project your portfolio to be once you reach the retirement year. You can allocate that portfolio based on any weighting you desire between these 7 asset categories, plus 5 additional user-defined options, and based on that weighting, plus the actual market historical return data from 1928 to 2025, you can test to see if your portfolio would survive for 30 years and provide you with the appropriate and desired standard of living during that time for any 30-year period within this range right here. Now, I know this is something that folks have been asking about, have been trying to figure out how to do. What if you actually retired right before Vietnam and Watergate and the market crashed in the early years of your retirement? Or if you retired right before Black Monday, or the inflationary market decline of 2022, or any other time during this time period right here when we had market downturns? How would your actual portfolio have stood up against the actual market returns of those time periods? We all know that history doesn't repeat itself, but it often can rhyme. And while we all know that historical performance is not indicative of future performance, the information, confidence, or concern that you might glean from the results of testing your numbers against actual historical performance could provide you with insights that you would otherwise miss regarding how to manage your portfolio in a downturn, how to prepare your portfolio for retirement considering the possibility of a downturn in the first 5 years, and perhaps most importantly, it may give you the confidence to say, you know what, I've seen this before in my previous financial planning, so that if during your retirement you face a downturn in the market and have to make some decisions about the best way to manage your portfolio at that time, it won't be the first time that you're analyzing what to do with your portfolio when the markets are not working in your favor. You will have the experience of analyzing how to deal with your portfolio based on all of the historical ups and downs, starting and ending with any 30-year period within this range. So now that we understand the basic functionality of how the portfolio survival calculator will work, let's jump into the FRPC and check it out for ourselves. So the first thing we're going to do is scroll over here to the right and take a look at these 3 data entry sheets. These are where the source information for the historical returns for all 7 asset classes are summarized, starting right here with 1928 and then going down to 2025 right here. As I mentioned, this information was downloaded from the Stern School of Business at NYU, and right here are the 7 asset classes that were mentioned earlier in the video. So to summarize, this is just historical information for every asset class listed here for every year starting in 1928 through last year. And also note that we have the same initial setup for taxable brokerage accounts, pre-tax accounts or traditional IRAs over here, as well as after-tax accounts or Roth IRAs here. Now, just so it's completely clear, it is not that the historical return is different between these 3 tabs. The historical return is the historical return. These amounts are the same on all 3 of these tabs for the 3 different types of investment vehicles. What is potentially different between them is the weighting that you are going to assign to each of these asset classes based on your investment style and risk tolerance and preferences between the 3 different types of investment vehicles. And that weighting is going to be assigned over here on the portfolio survival calculation. You can see right up here that I have the 3 different types of investment vehicles listed, and here are the 7 asset classes where the data is currently populated. You have the ability now to go through each one of these cells and assign a weighting to that asset class. For example, right now in the fully taxable brokerage accounts, I have assigned a weighting of 25% to the S&P 500, 10% to US small cap, 35% to 3-month treasuries, 0% to the 10-year bond, 18% to fixed income and BAA corporate, 7% to real estate, and 5% to gold. Based on those weightings, the portfolio survival calculator will take each year's actual return by asset class. It will multiply that return by the weighting that you have assigned to each asset class, and then it will sum up those values to determine a weighted average rate of return for each year from when you start the analysis through 30 years later. In this case, we have started the analysis in 1973. Those were not good years in the market. And you can see, based on the various weightings that I have assigned right here for purposes of this example between the 3 different investment vehicles, multiplied by the rates of return applicable to those periods, you can see various weighted average rate of return results right here in the first couple of years that are not particularly favorable. So again, the weighted average return for this first year right here would be based on the actual returns in 1973 multiplied by the weights assigned up here and then summed up to arrive at a weighted average. The amounts in row 2 would be based on 1974 and then 1975 and so on, all the way down for 30 years. What the FRPC is doing after that is assigning these weighted average returns by investment vehicle type to our portfolio starting in whatever retirement year we have defined right here, and again going out 30 years to develop what our base case returns will be looking like in the 30-year retirement period defined. And those are the amounts that will be used for portfolio growth that offsets the distributions that we are planning to take on an annual basis during the retirement years, which are defined and summarized over here in the 4% distribution rule calculator. Now remember that the point of this analysis is not simply to say, will my portfolio survive against historical returns? Anybody can apply a growth rate to a number and say that they have a financial plan. Instead, the point is to, number 1, set up a baseline retirement plan, and then, here's the important part, number 2, start tearing down all of the assumptions underlying the plan until we reach the most conservative core. For example, a base plan that has been derived using historical actual rates of return and weightings that you have defined will have within it income, expenses, the rate of return, which is what we're specifically talking about right here, distributions, inflation, and contingencies, all of these items set at a certain base level. And if your portfolio can survive this base plan over here, well, that's nice, but that's not the real test, is it? No, it is not. The real test is stripping down all of those assumptions to the most conservative core. We have to analyze what is the worst case scenario for income. What if income is lower than expected? What is the worst case for expenses? What if expenses are higher than expected? What if returns are lower than expected? What if historical returns are in fact not indicative of future performance? Well, then we have to strip those returns down. Those actual historical returns may be far too aggressive, and only by testing how low we can make those expected future returns and still satisfy your annual distribution and standard of living needs during the 30-year retirement period will we truly understand the resilience and longevity of your portfolio over your retirement years. Now, going to the next category, what if distributions are significantly higher than expected? We need to plan for that. What if inflation is higher than expected? What kind of contingency plans do we have built into the broader financial plan just in case things do not work out as initially anticipated in in the base plan. Only if your portfolio can survive this right over here, the conservative core, will you have the confidence to know when you can retire, how much you can safely spend annually while in retirement, and probably the most important thing, how to react to unexpected situations, market conditions, life events, and or financial shocks. Because by stripping it down to that conservative core plan, we will effectively transform the unexpected into the expected, so that you will be ready and you won't be considering these unanticipated events for the first time if and when they are actually happening. Instead, you will be prepared because you thought it all through already. And you know what? If the markets just run up continuously for the full 30 years of your retirement, then you've got nothing to worry about anyway. You know, every piece of financial advice that you've ever received and that you think makes sense deserves to be tested. You owe it to yourself to test it rather than just taking it as gospel. The financial advice that you have never tested for yourself represents the gap, the critical and dangerous gap between what sounds right from the podcasters and influencers and advisors and what actually works for your specific facts and circumstances. That gap is the untested financial advice, and you can bobblehead all day to the Dave Ramseys and the Susie Ormans and the Jim Cramers, and many people will. Yep. Oh yeah. For sure. Right on. Magnificent. Bye. But until you actually put that advice to the test with your own financial situation, all that noggin wobbling doesn't change the fact that the advice in your hands remains untested financial advice. That's where the financial and retirement planning calculator comes into play. The FRPC tests the gap between what sounds right and what actually works for you. Now, what are the major differences between the FRPC and every other retirement cash flow modeling tool that is out there? Well, the first major difference is transparency. Some of the other guys' tools work a little something like this. You enter something like 5 simple inputs, you enter one prayer, and then you get an answer that by its very nature could not have been determined in any reasonable way based on 5 inputs plus 1 prayer. Then you shake your head and you ask AI what to do. Alternatively, the other guys' programs may work a little something like this. You enter something like 500 different inputs, no prayers this time, and you get an answer that, well, it must be right based on how complicated this thing is. But since the calculations occurred inside of a black box into which you have zero visibility, how are you really supposed to know? That's one of the biggest complaints that I hear about other retirement planning software packages. And it's that folks can't understand how the output numbers were derived. And if you can't understand how the results were derived, then how do you know if you can rely on the results or if they are truly meaningful in your situation? And the answer is that you can't. Or alternatively, you can, and you can just take the results as a given, kind of like when your doctor hands you that new prescription, and then you get a glimpse of his computer when he steps out of the room, and you see that he's been chatting with AI. With the Number Crunch Nerds Financial and Retirement Planning Calculator, the entire black box world of financial planning gets completely flipped on its head. Inside the FRPC, you can see every result and every calculation from where the result was obtained. The FRPC has 100% calculation transparency. Your entire financial situation can be traced from beginning to end, and we're talking about where every dollar comes from, where every dollar goes, how every dollar grows, how every dollar gets taxed, how every dollar impacts your net worth, how every dollar impacts your cash flow, and how every dollar runs through your distribution planning during retirement. Your entire lifetime cash flow planning cycle in one place with 100% transparency. I like to say that transparency is not a feature of the FRPC. Transparency is the foundation. Now, the second major difference between the FRPC and the other programs is going to be the training. You will receive extensive video-based training from day one that combs line by line through the FRPC, leaving no stone unturned. You will understand, number one, how the FRPC works. Number two, how to use it. Number three, how to scenario test financial strategies. Number four, how to interpret the results. And number five, much more. The FRPC doesn't compete with your financial advisor. The FRPC makes you a better client, because for the first time, you will have a place to bring and test out all of your financial advisor's recommendations. Does their 6% return assumption hold up against your actual retirement spending? Does their distribution strategy sustain your cash flow in year 23? Does their plan actually produce the retirement that they promised? The FRPC lets you find out before you bet your future on it. Now, if you are already a member of the Financial and Retirement Planning Calculator program, you have immediate and total access to all 2026 updates that I have recently uploaded to the members area. So for folks who are already members, you can simply log in and check out all of those extensive updates at your convenience. And if you're not already a member, the FRPC is your ticket to the answers that you've been searching for such a long time, but have only found as high-level, anecdotal, unsatisfying, incomplete, one-size-fits-all, or impossible to verify. Answers to questions like, will my money last through retirement? Is my cash flow sustainable? Am I on track? What happens if returns are lower than expected? What happens if I live longer than planned? The FRPC doesn't guess, it calculates. You can join the FRPC program with lifetime access for a one-time access fee at the link in the description below this video on YouTube, and I look forward to seeing you inside the class.